In essence, artificial intelligence is a black box. You put the data into one end and take the outcome from the other one. There's little to no consensus between scientists on what actually happens inside the box that makes it so good at nonlinear predictions. A combination of various AI techniques makes our predictions work. Let's take a brief look into how our predictions are born. To add some precision by saying black box or deep learning, I actually mean a stacked approximation function which is proven to be good at finding patterns in nonlinear data. To get better approximations with such algorithms, scientists have two options. First, one can give an algorithm huge amounts of data so that it finds patterns and approximate possible outcomes better. Second, one can give an algorithm a stronger signal about some patterns. For example, if you would like your algorithm to learn to predict weather, it might make sense to give it not only raw historical data, but also the month number for seasonality, satellite images, so that it can find the relationships between cloud movements and weather, and so on. In our case, you might think we already have a huge amount of Forex historical data, and that's it, but it's not. Mostly, the signal of raw historical data is too noisy and inconsistent, so we must make it stronger. That's why we continuously look for better predictors that can enrich raw historical Forex data and make our predictions even better. After we process the data, we, simply speaking, put it into some black box where it is training or looking for relationships between input and output data. Then the magic happens, so to speak. The data is being processed by our algorithm and a prediction is born. To describe the process of prediction, allow me to use an analogy. Imagine a class full of students. We have 200 agents making predictions for each pair. The whole class gets the same set of data, and each student is studying the data on his or her own. Then, each student, based on the data he or she has received, must make a decision, a prediction, about what the price will be for the next day. The student must predict the possible highest and lowest price points that the instrument, or currency pair in our case, can reach over the coming session. So now we have 200 students who have studied the data and come up with two predictions each, the highest and lowest price points for the next session. The whole process takes a bit over 4 hours on our 32 processors, of more than 2 gigahertz per processor. It's like 16 normal laptops. That just shows how much computing power these predictions need, and it explains why nothing like this is mainstream yet. Once the predictions are done, we put them on the chart similar to what you can see on the screens now. As you can see, there are two sections on the chart. On the left is a blue part with the predictions using the daily or weekly lowest price as one of the inputs. On the right are the yellow predictions of the highest price point as an input. As you can see, we have multiple price points on the chart. Those are identified on the left here. The length of the bar and the numbers on it represent the agents or students who predict in the future given the historical lowest or highest price. And here comes the part that's a bit tricky. The single prediction we get is actually a point that can be reached in the near future. At least, each student thinks so. But it's not an actual high or low price. Why, you ask? It's done intentionally because it would be way too risky to trade with high and low points only. Think of it for a bit. If the prediction is 1 pip above the high point, you lose. If the prediction is 1 pip below the low point, you lose. It's way easier to predict points in the range between high and low. That's why we optimized the algorithm to seek values that can possibly be reached, not the actual high-low points. So, going back to the students, we look at the density of the predictions to determine the most probable reaching values. In other words, the more students who predict reaching a certain price point on a histogram, the higher the probability of reaching that price point. After long hours of testing, we found out how to read and interpret histograms that are made of these predictions and calculated probabilities for the three most useful events. Probability that the price will increase. Probability that the price will stay in a range between the current high and low price. Probability that the price will decrease. This is the view you'll get right after predictions. Our calculations take around 4 hours to compute. Thus, we have 4 one-hour candles already on the graph. The prediction is valid for the day, or a week for the weekly ones. This means that to compute the probability of the price reaching a certain point, we must exclude the price points that have already been reached. In this example, you can see that the price has reached the 1.044 level today and then stayed sideways without touching the price point above or below the current one. Therefore, it still has chances of reaching them, and these percentages on the side give you the probability. In this case, the pair has a 58.1% chance of reaching 1.038, a 35.4% chance of reaching 1.032, and so on. To the other side, it has a 26.1% chance of reaching 1.050 and only a 14.8% chance of reaching 1.056. Now, let's look a bit below the chart. We have a table there, and from this table, two numbers are of particular interest for us: modes. Modes are the values that appear most often in a set of data. In our case, the price levels with the most guesses from the agents. Or, in other words, the largest number of agents predicted the price will reach this point within a given session. This makes these levels really powerful. In our case, we have both modes on 1.038. In this specific case, both modes are below 1.044, which makes the odds of the price going down much larger. This brings us to another topic: how to read and interpret equalized predictions, and how to select which ones to use. There are several parts to it. The first thing we want to look at are the modes. Modes are really powerful places, and you must pay attention to them. These are the spots with the largest number of guesses, and that makes them power zones. A few questions you want to ask yourself are the modes above or below the current price? Both of them, or just one? Perhaps the price is between the modes. Are the modes reachable within the next session? Are they not too far away based on normal average range and similar? How tall are the modes? Tall modes signal more certainty, but in some cases, you might want to be careful because they can be too tall, signaling that the prediction is not trustworthy. Let's take a look at a few examples. As you can see in the image, the current price is between two modes. The yellow mode is on 111.0, and the blue mode is on 110.1. What does that mean? It means that there are some disagreements between high and low predictions. So, while trading according to prediction, the take profit could be somewhere around 110.4. We must sell according to the current price because it has the biggest prediction. Of course, we would be more sure if both modes told us the same direction. As you can see, the price reached 110.4 and then bounced back up. Here's another example. As you see, we have a 51.6% probability that the pound will reach 1.245, meaning that we must sell it. On the yellow side, we see an almost perfect normal distribution with a mode that is already reached and has been reached since the third candle. On the blue side, we also see a very pretty looking distribution, which indicates that we should be looking to reach 1.245. Let's take a look at the result. As you can see, 1.245 was reached, and then the price bounced back up. The next part is to look at the bell curve, or how well distributed and close to normal distribution the guesses are. We look at both sides and evaluate blue and yellow predictions separately. Ideally, we want to see a lot of predictions clustering around one point and see a number of guesses dropping by, going to any side from the largest one. This is what a perfect bell curve distribution looks like. Every normal distribution has certain properties. You must use these properties to determine the relative standing of any particular result on the distribution and define probabilities. The properties of any normal distribution are as follows. Its shape is symmetric. That is, when you cut it in half, the two pieces are mirror images of each other. Its distribution has a bump in the middle with tails going down out to the left and right. The mean and the median are the same and lie directly in the middle of the distribution due to symmetry. Its standard deviation measures the distance on the distribution from the mean to the inflection point, the place where the curve changes from an upside-down bowl shape to a right-side-up bowl shape. To give you a better understanding, let's go through some real-life examples. Take a look at this example. Now, see how nicely the yellow histogram is distributed? Looking at the blue one, we see it's a bit skewed downwards, and its mode is a bit below. Let's see how it turned out. Looks like it turned out just great. Both modes reached. Now, a bit different example. You see how tall modes are? The blue one has 97 predictions. That's insane. We should sell. Really? No. Just because the probabilities are in place, it doesn't mean you should sell. Both histograms here are distributed horribly. When histograms are so sharp, we mostly skip these trades because there's a huge probability that something is off. Let's see how it turned out. Told you so. It turned to the other direction, as you see, so we dodged a bullet there. After evaluating the modes and the distribution of predictions, we can estimate the potential profit of each. To do so, we've made a spreadsheet which is available to all our members. Let's go through some pairs and fill it in together. Let's take a look at historical predictions and see how it worked out. Here we will show you 4 currency pairs: euro, pound, dollar, and yen. All of their predictions are for the New York time zone. We can fill in this Excel spreadsheet step by step and you'll see how it works. Here's the euro prediction. Now, we must answer some questions. Is the yellow histogram distributed normally? As we can see, it looks almost like normal distribution. A bit skewed downwards, but the direction is quite clear. So let's insert yes into the euro high cell. Is the blue histogram distributed normally? It actually looks like a by-the-book normal distribution with some very minor exceptions. So let's insert yes into the low validness cell too. We should also enter the current price so we can get the calculations accurate. Now, what is the direction suggested by the equalized prediction? This one is easy. It's sell. Pips at stake for the euro seem to be around 40 if you are looking to reach the mode, and a bit less if you are looking to reach only the first row below the current price. When you actually place trades, you'll be able to see an actual price, so it will be a bit more accurate. Now you can see that take profits and stop losses are already calculated. To go further, we must enter a few more numbers. Let's see what the probability up is at the histogram. It's 3.3, very low. Now let's enter the probability down. It's 91.3, looks great. And the last one, probability to stay in range, it's 5.4, great. Now that we have the first row filled in, let's review what we've got there. The calculated certainty is enormous, 82.6. We have 3 different stop losses and 1 take profit. We also see the validness of the histograms here in the table, so it will be easy to make a decision. But we must fill the rest of the rows to get the conclusion. The next currency pair is pound. Let's take a look at that. Again, cell by cell. Is the yellow histogram distributed normally? Kind of, but as you can see, the mode is already reached. So we can't say that the histogram is valid. Let's enter no here. Is the blue histogram valid? It's distributed normally, the mode isn't reached. The only thing missing is that the blue histogram mode is a bit out of the normal pound daily range in pips. But it still shows the direction with great confidence, so let's enter yes here. As you can see, the current price is around 1.228, so let's enter this number here. The direction looks to be a sell since it has a higher probability. Pips at stake. The biggest probability is for 1.224 and is around 40 pips below the current price. So we can enter this number here. Again, you see how take profit and possible stop losses are calculated? You can adjust them since you might want to try other multipliers, like 1.2 for stop losses here. Going further, let's enter probability up. It's 27.4. Probability down, it's 56.5, and probability to stay in range, it's 16.1. Also, certainty is calculated, so we could make the decision easily. This time, we have not had that much certainty, 13, and one of the histograms is invalid. We can leave that as it is for now and enter the third prediction data for Swiss. Here's what it looks like. Again, does the yellow histogram look normal? And does everything look fine with it, including that the mode is on the bigger probability side? Well, 16 predictions on the current price and only 9 on the row above looks a bit strange. But other than that, it looks quite normal, so let's enter yes here. What about the blue distribution? It looks enormously good except for one thing. The mode is already reached today, but it's a bit skewed upwards, so we can enter no. But let's try to remember not to draw many conclusions from it since the majority of predictions are above the current price. The current price is around 1.01. The direction is obviously buy. Let's see how many pips we can reach here. And we have more than one option. First would be to place take profit on the first row above the current price. This way, our pips at stake would be around 20, maybe a bit less. The second option is to place take profit on the mode, since it is in a daily USD CHF normal range. Choosing this option, we would have around 40 pips, but it's a bit riskier. I don't mind the risk, so I'll enter 40 pips here. Take profit and stop losses are in place already, so it's great. Now we can move on to probabilities. Probability up is 63.9%, down 19%, stay in range 17.2%. Calculated certainty is 27.6. As we already have 3 currencies, we start to see some patterns here. Which trade will be most trustworthy? Which currency would you buy or sell with the least number of units? I'll leave these questions unanswered until we have a full table so you can start thinking about it. Now, the last currency pair is yen. Here's what it looks like. First of all, again, is the yellow histogram and its evaluation. Does it look normal? Yes, but take a look at the current price. It is almost between 2 modes because the difference between the mode and the other high probability rows is just 1 prediction. This is worrying since half of the predictions are above and half are below the current price, so it can go both directions if you're looking at only the yellow histogram. So let's enter no here. And for the blue histogram, everything looks kind of nice. Let's insert yes in this cell. The current price is around 114.2. The direction with the biggest probability is sell. Now, about the pips. If we would seek to reach the first row above, stay in range, it would be around 60 pips. It's a bit out of the daily yen normal range, and the fact that it's so far away from the current price indicates that the standard deviation of predictions is quite high, meaning that we have a bit less certainty than it might look here. So let's be a bit more conservative here and enter 40 pips. We will be able to adjust this number after we see an actual certainty computed. For now, we can move on to probabilities. Probability up, 26.6%. Probability down, 59%. And stay in range, 14.4%. That's it. Our table is complete, and we can start reviewing the results. Now, we have one currency pair that stands out in our little crowd. It's euro. It has the biggest certainty and is the only currency that has both yeses. We should definitely sell most units of euro. The pound looks to have the least amount of certainty, only 13. So we must decide if we are skipping it or if we are lowering the number of pips here from 40 to maybe 15 or even fewer. Lowering pips means lowering stop losses too. So we run the risk that the stop loss will be triggered before reaching our target. So we'll decide to skip it. For Swiss, we noted that we shouldn't make a lot of conclusions from the no cell. Except for this, trade seems quite valid since the certainty is above 20. This trade can be performed with an average number of units in place, since it isn't either very good or very bad. Yen doesn't seem very good. It has a low certainty following, with a yellow histogram validness issue. Again, 2 options here. Either skip it or lower pips at stake, since it seems very risky. Have you decided what you would do? Did you place your trades somewhere in the notebook? All right, let's see the results. Here they are. Euro. Looks like we reached the maximum here. If your objective was 40 pips, you would already have them in your pocket. Congratulations. Pound. Also, the prediction turned out as expected. If you would have placed take profit at around 20 pips, it would have been reached. If you would have skipped it, it would have been a wise decision too. Swiss. Look, it reached the mode. Hope you placed your take profit on 40 pips. It turned out fantastic. Yen. Again, the doubts about this currency pair weren't without reason. It went the other way and got back to the starting price. I hope you decided to skip this one. It doesn't seem that difficult, does it? Around 80 and 100 pips could be in your pocket by now, and as you see, it isn't rocket science. But don't worry if you find this a bit complicated. We have a quick cheat sheet available to all attendees of this webinar, which will supercharge your learning curve. This is the flow we suggest you use every day to make trading decisions. You start at the top left side and follow the line. It's a pretty self-explanatory guide through all the steps you must take to evaluate evilized market predictions and prepare your trading plan. One more thing to keep in mind while trading with evilized signals is the fundamentals. Our algorithm is not taking into account fundamental factors, and for you, this means two things. First of all, if there are major news events this day that might influence the pair you are looking to trade, you need to be aware of that. We suggest that you take a look at the calendar for the day and see which events might influence your trades. Then, make a decision. Another factor is that after big changes in fundamentals, or if market sentiment changes, it takes some time for the algorithm to adapt to the new situation. Thus, for example, if something would happen, let's say in the Eurozone, and that event changes the Euro sentiment from, let's say, bearish to bullish, you should be aware of that and ignore any signals that suggest to sell Euro. After several sessions, our algorithm will adjust itself to the new conditions and adjust predictions accordingly.